Talking about the 3 takeaways that investors should have after the week that was in the market. Certainly a rough week if you were following the market, even though it was a 4-day week with the Martin Luther King holiday there on Monday. It certainly was not a pleasant one for equity investors. The overall market's down anywhere from 5 to 7%, depending upon what index you were looking at. And so certainly that's representative of perhaps this realization that 3 things are happening out there. First and foremost, the easy money out of Washington may in fact be coming to an end. No more stimulus money, despite conversations about trying to get another round of that. The appetite just does not seem to be there, combined with the fact then that you've got the Federal Reserve that is in the process of raising interest rates. I think it's very clear. They've already said they're going to raise them at least 3 times this year, perhaps maybe even more, to combat some of this jump in the inflation numbers. And then lastly, with COVID itself, certainly that is still out there, but I think more and more people are just kind of taking it as a fact of life more than anything. And so consequently, you're seeing the companies that sort of did well during those periods of time, or that experienced a heightened demand for their products and services, maybe not having the same level of demand that they had a year ago when everybody was sort of locked down into their homes. So what does that mean for investors? Well, we've got 3 things that investors need to be aware of, particularly after last week. Number 1, market volatility is in fact quite normal. If you look at the history of the market going back over the past 100 years, you're going to see that volatility is a normal part of that upward trend of the markets. That's why it's hard to be an investor consistently and over time, is because you have these periods of time where the market goes down. That's part of it. And it's a normal part of the market. But because last year was an incredibly smooth year, we didn't really have much volatility throughout last year. And you could even go back to March of 2020, a year and a half plus, where there wasn't a whole lot of volatility in the market. So people forget that, oh, wait, this is a normal part of the process. So remember, normal volatility, market volatility is normal. May have forgotten that it was, considering the smooth ride over the past 18 months. I think maybe a lot of investors did. That's particularly true when you see odd asset classes like your cryptos going up through the roof. People think, oh, it's just going to keep going up and up and up, and I'm never going to have to reconcile risk in this picture. Yeah, it doesn't happen that way. So number 1, market volatility is normal. Number 2, and certainly something we've said before on the program, volatility loves company. Volatility loves company. Once you have volatility in the markets, it doesn't just simply instantaneously go away. It usually sticks around for a few weeks. So what that means is that there's probably some more of this. So buckle up for the bumpy ride, but make sure that you maintain that longer term perspective. Just because you've got volatility a few weeks here and there doesn't mean that the next 20 years or 30 years are not going to play out to your benefit in terms of your investment approach and retirement planning. That's the perspective you've got to maintain. Not what's going on this week, but what you expect to occur over the course of the next 5 years, 10 years, 20 years. Because remember, while you may be going into retirement today, that doesn't mean that your life is ending. It simply means that there's a whole nother 20 odd years where your money has got to be doing what it needs to do in order to generate return, in order to generate income to help you pay your bills. So, but beware, volatility loves company. Number 3, if you're regular listeners of this program, you know that we've been talking a lot over the course of perhaps really, I think back probably the past year, about this notion of rebalancing. In fact, I know it's been over a year because when we sent out our January letter to our clients, and that was in the mail last week, we talked about the fact that last January's letter talked about volatility, expecting volatility and how normal that is for the markets, and the fact is that we hadn't had much of it. Well, fast forward a year later, wasn't much volatility either, but at some point that volatility comes in. So that's certainly one of the things that we've been talking about, and how to deal with that or how to address that. Well, that gets the importance of rebalancing, and certainly when you think about rebalancing, what does that mean? Well, it involves looking at the mix of stocks versus bonds, and then it involves looking at the types of companies that you own. Are they large companies? Or are they small companies? Are they growth companies, tech companies, or are they more value or dividend paying companies? So it's important when you, as an investor, to look at that mix of companies that you own and that ratio of stocks to bonds. Obviously, bonds being more conservative, stocks being less so, but a rate of return trade-off, if you will, on stocks versus bonds. And so to take a look at that and do that kind of a rebalance on a regular basis, certainly something that we've been talking a lot about on this program over the course of the past year. So hopefully you did that. Hopefully you rebalanced, reduced down the stock, went a little bit more into bonds because of the appreciation in the market, maybe trimmed out of the growth, went more to value, dividend paying side of things. Because if you look at that difference right now that's playing out in the market, the value or dividend paying companies are having a tendency to stay up a little bit more, not go down as much as some of these more growth oriented companies. So those are certainly the three takeaways. Number one, normal, market volatility normal. Number two, volatility loves company, so don't think that all of this is just going to magically disappear. It's usually around for a few weeks. And then number three, rebalance, rebalance, rebalance. We've certainly talked about that a lot. If you've done that, then you should be able to just sit and enjoy the football games this afternoon without having to look at your investment portfolio. If you're rebalancing your investment portfolio along the way, then you should be able to weather whatever the storm is that may happen over the course of the next few weeks, months, or years. So that's the takeaway for investors. In a sign of the times, not sure if you saw this, but certainly if you are a member of the Florida retirement system, you probably got a letter here a few weeks back, and I guess it is sort of the sign of the times. It is from the Florida retirement system. It went to all members of the investment plan. So remember, in the Florida retirement system, there are two different things, right? There's the pension plan and the investment plan. So this had to deal with a notification for FRS members in the investment plan of, in fact, a data incident. Apparently a security incident at a third-party mailing vendor involving personal information. The good news is that apparently there wasn't a misuse of personal information. Bad news is that this is just a part of life, right? This is a part of reality. I think by now pretty much everybody has gotten these kinds of letters, whether it's a security breach with your credit card company, your phone company, your retirement system company. It is a pandemic in terms of, or endemic across this country, that these are the kinds of letters that happen. What happened here with the Florida retirement system is a company called Quantum Color Graphics, a vendor for Alight Solutions, who happens to be the FRS investment plan administrator, whose role as a printing company was to print out and mail the statements to FRS investment plan participants, had an incident that resulted in an intruder posting a set of Quantum's files online. So that is what happened. That's, like, unfortunately the course of action. The information on those statements included names, addresses, allocations, all of that. Did not include social security numbers, and it was as a result of a software vulnerability that has since been remedy. Again, the good news here is that they're not aware of any misuse of information, but they are offering you that free service of credit monitoring. And shoot, if it's free, maybe that's something that you as an FRS investment plan member might want to take advantage of. So be aware that that has happened and it's part of life, but certainly you get the option to be able to take advantage of a credit monitoring service. Anyway, we're gonna slide to the break. When we come back, we will return here on Dollars and Cents with your host Joel Garris of Nelson Financial Planning.